Welcome to this video brought to you by myself, Omar Aswat, a chartered tax advisor. I'm going to get straight into this video. There's a lot of talk about, property incorporations and how it should be done, and issues with certain less tax for landlords, talking about business property relief being available on property investment partnerships, which is totally incorrect, to be straight and to be clear, and other outlets as well. So, I just thought I'd make this video around property incorporations. Broadly speaking, we'll discuss 5 advantages of incorporating your property portfolio, 3 disadvantages, and then 3 obstacles that we need to think about before even making the life-changing decision, because it's not something that's just reversible overnight. You make the decision, you gain the analysis, the professional analysis beforehand, and then you make the decision to go into incorporating your property portfolio into a limited company. Before we go on, don't forget to like, comment, share, and subscribe to this channel. And if you have any questions, comments, leave it down below, or you can always reach me on my email address, omar@aswatax.co.uk. We are chartered tax advisors regulated by the Chartered Institute of Taxation. As I say, straight into it. So I think I'll go with the obstacles first. So 3 items or 3 things we need to consider before we incorporate. So properties held in a personal capacity or within a partnership. Incorporate, we mean transferring them, incorporating them into a limited company. And the 3 obstacles would be that we need to look at the CGT issues first of all. So broadly speaking, in the absence of any relief being available, and particularly in this instance, Section 162 TCJ 1992 incorporation relief, which has conditions that need to be satisfied, subject to the relief being available, the transfer of the properties from your personal or partnership capacity into a limited company is into a separate legal entity. So therefore, at that point, there's a disposal by yourself as an individual, your personal self. There's a disposal for capital gains tax purposes on transferring into the limited company. I hope that's made sense. So by default, there's a capital gain arising. So whatever your base cost was, whatever you purchased the property for, and then the market value on the date of incorporation, there would be capital gains tax to be at that point. And it'd be a market value. Why? Because the company would be treated as a connected company. So therefore, capital gains tax is the first obstacle to work around. And that's the first analysis that we need to do, whether incorporation relief is available or not. So the second point would be the stamp duty land tax issue. So as soon as we're talking property, we're thinking things like income tax, capital gains tax, inheritance tax, and of course, no doubt, stamp duty land tax. So we have to consider stamp duty land tax when we looking at the transfer of properties. And again, separate legal entity, at that point, market value, deemed market value, even if the properties are being transferred for no consideration, for under legislation, it'd be transferred at deemed market value. I'm not going to give the section numbers for every single aspect that I'm talking about, because obviously this video is not aimed, it's not here to, I'm not here to explain to a tax partner, for example. So we'll just leave it. I'll try to keep it basic, but then at times I'll throw a few legislation points out. So STLT, which can be quite large, as in the exposure can be quite significant, we need to then, that's the obstacle, we need to work around how to potentially, I don't like to use the word avoid, but avoid stamp duty land tax. And that's when we start looking at the use of a potential partnership. So that's what background work that we need to do as part of our assignment. And the third point would be the transferring of mortgages into the company, because if there are any mortgages outstanding in your personal capacity, the transfer of the mortgages into the limited company, how is that going to work? What are the mechanics behind it? For example, if the if the what's the word? I forgot the technical word, but if your mortgages are coming to an end, is it better to wait and then incorporate at that point, or what's the discussion with your mortgage provider as well? So these are three obstacles: CGT, SDLT, and the transfer of mortgages into the limited company. We move on to the 5 advantages. So the first advantage that I want to speak about, or the popular advantage, and the reason why many landlords began to incorporate since the introduction of new rules in April 2017 in terms of mortgage interest relief being restricted for property landlords in their personal capacity. So a mortgage interest relief is restricted, but within a limited company, there is no restriction on mortgage interest. And this is so some landlords with large number of properties, and most of them on mortgage, they'll be paying monthly, they'll be paying large significant amounts of interest. The interest expense would be quite high. Now if they can only deduct 20%, for example, of the interest cost, then they are at a disadvantage. And it so happened that you'd be making a cash profit, but then, as in if you look at the numbers, I can't explain. I don't want to explain to you just by telling you random things. But broadly speaking, it put landlords at a major disadvantage. So transferring the property portfolio into a limited company allows for full mortgage interest relief to be available. So an expense is available. Now, I just want to caveat that point in the sense that, these rules are always subject to change. We don't know if this will always be the case. So these sort of angles need to be considered. And that's why I always like to give the full picture. We can't say for sure, we're not HMRC, we don't say for sure that mortgage interest relief will still fully be deductible in the next few years. We don't know. But for now, yes, it is, as of today, 21st of October, 2023. So that's a key benefit. It is a massive benefit. So we can't downplay that benefit. The second benefit would be the properties in your personal capacity being transferred into the separate legal entity, which is the limited company that you're the shareholder of, or you, your wife, your children, whoever is involved. The properties are transferred at, the properties are transferred at market value. Now, this is a massive benefit. So just hear me out. This is a massive benefit for landlords who bought their properties many years ago and are sitting on large, significant, massive capital gains and are looking to sell 1 or 2 properties. If this is you, then this is a key benefit that you should consider, which is that the properties transfer over at market value. So the base cost, so it's an immediate CGT uplift in base cost for the limited company. So effectively, let's just say today, 21st October 2023, you incorporate and you transfer the properties into the limited company. One of the properties from the 15 that you're transferring, let's say, you purchased it for 50,000 in 1990, and today it's worth 400,000 pounds. So you're sat on a gain of 350,000 pounds. 350,000 pounds at 28%, we're looking at about 100,000 pounds CGT. You transfer into the limited company by claiming incorporation relief, so no CGT at that point. And then you literally sell it tomorrow, 22nd of October. You sell the property, you pay no capital gains tax. Why? Because the company is disposing of the assets now, that property for 400,000 pounds. And the base cost for the company also becomes 400,000 pounds. So keep that in mind, a massive benefit. So number 1 is mortgage interest really fully deductible. Number 2, the immediate CGT uplift in base cost. So it's beneficial for those landlords that are sitting on significant capital gains. Number 3 is that corporation tax, it's a simple point. Corporation tax is lower than income tax. So even though the corporation tax rates have gone up from 19% to 25%, and that's not for all businesses, it's on a sliding rate. So 19% for profits £50,000 or less. Profits in excess of £250,000, we're looking at corporation tax at 25%, and anything in between, we're at a sliding rate, at a marginal tax rate. So broadly speaking, 25% is still lower than 40%, 45% income tax rates. Agreed? So therefore, there's benefits there whereby the rental income is subject to lower rates of tax rather than in your personal capacity. I just want to add a further point, which is that what was I going to say? The other benefit. Okay, sorry. Let's put this with the fourth point. So that was the third benefit. The fourth benefit is you have the flexibility and control of income extraction. So listen to that one very carefully. The flexibility of income drawdown and control. So when we say the flexibility of income, now as shareholders of the limited company, you have the ability to draw dividends rather than salary. Dividends are cheaper than salary for three reasons. One is the income tax rates are lower. Number two, you have the dividend allowance at £1,000 and no NICs are attracted on dividends, although there is the corporation tax that then needs to be paid. But you do have the flexibility. That's what we're looking for, right? We're looking at salary, dividends, and potentially other aspects as well that you can explore in limited companies. See my other video, we'll perhaps tag it up here, which is extraction methods for business owners. And the side point with that would be the control as well. So in your personal capacity or in a partnership or LLP for that matter, whatever income is generated in that tax year is subject to UK tax in your personal capacity regardless. Within a limited company, you can shelter certain funds and only extract whatever you require. So a lot more planning can take place, and that's where we start looking at the introduction of the not a off-the-shelf limited company, but the incorporation or incorporating into a family investment company, a bespoke company that we can produce to facilitate for yourself and for your family members. So, we can literally put in certain aspects which allows for who has the control, who has the voting rights, who has the dividend rights, capital rights, who's getting what dividend, which class of share. There's a lot we can play around and facilitate in such a way where it's completely bespoke to you and your family's circumstances. So we never just throw, a boilerplate solution and just say a blanket approach, just say, yes, everyone should do this. A share for this person, B shares. It's very bespoke. And we literally start with a blank piece of paper. That's the way we start. When it comes to family investment companies, we start with a blank piece of paper and we look at, or we understand your objectives, your near-term goals, your medium-term, long-term goals, who's involved, how much money do you need to currently live, how much would you need in the future, how much control do you still want to exert? Shall we look at the insertion of a discretionary trust for the benefit of a class of beneficiaries, children, grandchildren, and the rest of it? The fifth point would be, which brings me on to the fifth benefit, which is that incorporating your property portfolio into a limited company is a lot smoother and easier and more efficient for inheritance tax and succession planning. So bringing other family members into the mix, planning for your inheritance tax liability, because as we mentioned at the start, business property relief is not available on a property investment company. It's not available. I don't know who's even come out with that. That would be amazing. But that's not the case. So therefore, we have to plan actively, proactively for inheritance tax purposes. And probably one of the first steps would be to the elder generation freeze the value of their assets. That's like sort of stage one, which is, stop a problem from getting worse. So it's smoother for IHT planning. Why? Because it's easier to deal with shares rather than bits of one individual property. So you might have 20 properties, this property here, that property there, giving 33% here. It doesn't make sense. It gets too tedious is a good word to use. So those are 5 advantages. I just want to reiterate. The first advantage is mortgage interest relief is fully deductible. Number 2, the immediate CGT uplift in base cost to market value within the limited company. Number 3, corporation tax rates are lower than income tax rates, 19-25% rather than 40-45%. Number 3, we have a lot more flexibility for extraction of income, salary, dividends, and a lot more flexibility over the control in terms of, when you are paying tax. So for example, in your personal capacity, you have to pay tax on your rental income whether you like it or not. Within a limited company, income can be sheltered. And number 5 is it is a lot smoother and easier and less tedious for inheritance tax and succession planning. I hope that's made sense. I hope I'm not speaking too fast. Next, we go on to 3 disadvantages. Number 1 would be that, and this is like a typical disadvantage, and usually the benefits completely outweigh the costs, but you have a limited company now, so there's additional compliance, probably additional costs as well from an accounting perspective. Why? Because of the additional compliance, which is due to the fact that we're dealing with a limited company now. So we have the confirmation statement, accounts to Companies House, CT 600 to HMRC, and the rest of it. Number 2, the second disadvantage would be that all properties must be transferred for relief to be available. So I mentioned that Section 162 incorporation relief has certain conditions that must be met. And one of the conditions are all assets, except for cash, all assets are transferred into the limited company. Therefore, if you have 1 or 2 properties, that family members use, for example, then you might have to just rethink and see how you can work around that. It's not the end of the world, but all properties, whether you like it or not, must be transferred for incorporation relief to be available. If incorporation relief is not to be available, then you can choose which properties are transferred, but gift holdover relief will not be available. Why? Because gift holdover relief under Section 165 is only available to trading assets. Okay, so we have to be looking at Section 162. And finally, the third disadvantage would be that if there's an issue in mitigating capital gains tax, so relief is not available, and or stamp duty land tax, so again, relief is not available, then most likely it's probably not worth it, just because we probably be looking at significant tax exposure. But again, case by case basis. So it might be that incorporation relief is available, but STLT relief is not available. So then we just have to weigh out the pros and cons in your particular circumstances. That step on property incorporations is not over there. So many accountants and advisors as well, they just they talk about the mortgage interest rate. That's what they'll talk about, but they don't talk about the other issue, which is the inheritance tax issue, which is sat right in front of you, the elephant in the room. Property investment companies don't get relief, and therefore what we do as a firm is we immediately discuss the inheritance tax exposure and how we can potentially assist you on that matter as well. Family investment companies work very well. Discretionary trust, blended approach is excellent. This is something we regularly look at for our clients, so we're always looking at this. There's always cases on the go. Currently I'm speaking to I've got 3 cases on the go currently in just this aspect, and I've got 4 in the pipeline. So as a firm of chartered tax advisors, we can assist in these matters properly, without doing these funny things that some of these firms do. And you can rely on us. That's my point. You can rely on us. And I hope you find this video beneficial regardless. Don't forget to like, comment with your thoughts and your questions, share and subscribe to those who may also benefit, and subscribe to my channel as I bring you regular tax planning videos. And don't forget to reach out to me. My email address is down below if you'd like to have a chat. Just a recap on the obstacles. The key obstacles would be CGT, STLT. I want this video to get to 20 minutes exact, so I'm just talking about this again. CGT, STLT, and the transferring of mortgages into companies. So that's where the commercial aspects need to be looked at, and that's again something we're experienced with. I shall speak to you soon, and don't forget to reach out if you have any questions. Take care.